Okay, everybody, what we're going to be doing today is starting the beginning of a series of webinars. And we're going to start off with market geometry. Okay, we have some of the basics on the website already, and I'm going to proceed and we're going to build around uh, trends and ranges, and we're going to expand over many weeks, learning about market geometry, market internals, what makes the markets work, support, resistance. We're going to go through all of that over the many weeks to come. We haven't done much for IML in 2013 in terms of what I wanted to accomplish with the webinar series. I've been racking my brain back and forth, which is the best direction to go. And what I'm going to do is we're going to start off, and today is going to be extremely basic. All right. I'm going to come in assuming that we all know what a chart is, that we know what a bar is, but I'll run through a couple of things. But essentially, we're going to keep it basic today. I don't want to feed you too much for the fact that if I give you too much, you're not going to retain it as much, and also it's going to be overwhelming. So what we're going to do is I'm going to go through step by step with the very foundation of technical analysis of trend, range, price relationships, and I'll give you at the end just a sketch out of what Elliott wave looks like. And I look at a lot at Elliott wave. We look at harmonics. I'll show you a little bit at the end about that, but I just want to keep it consistent over many weeks. And this is going to be the foundation, as I said. And then next week we'll come up with another and another and another. And I'll have a nice webinar series in the back office. But market geometry to me is an essential foundation of trading. I don't care if you're doing Forex, futures, crude oil, gold. It doesn't matter. If you like understanding market geometry and Fibonacci and all those mathematical equations, which is very simple, believe it or not. It just sounds exciting. So let's just get going and talk about what we're going to cover today. All right, we're only going to cover 5 different ideas today, 4 different ideas. We're going to cover trend. We're going to cover range. We're going to cover price relationships, what we call an A to B, C to D relationship. And then we're going to cover basic beginning of Elliott wave. In the future, we're going to expand on Elliott wave. We're going to look at lots of charts in Elliott wave, and then we're going to expand from that into harmonics. And harmonics are basically patterns that were discovered by a gentleman, Bryce Gilmore. There was Larry Presavento. There was some of the players out there, Scott Carney. They do a lot with both market geometry and these patterns. So the first one that was out there was called the Gartley pattern. And if you guys remember, a couple of months ago, we were doing that Wednesday webinar, and I drew out the Gartley pattern. Well, that's what that is. That was the first one that was developed. And then from that point, gentleman Scott, his name is Scott Carney, and I know him through the Market Technicians Association and the Association of Technical Analysis, and we've met on many occasions. And he's just a real good guy, real smart. And he's put together a book on market harmonics, butterfly patterns, bat patterns, crab patterns, and I even still to this day I look at his work, and you're always learning something. So one thing's important in the markets: always just seek to always learn. I've always looked at different big industry leaders in the markets. Always to this day, I've always learned, because you could always learn something, and you never stop it with the markets. That's the great thing about it. So let's talk about what is a trend. Okay, a trend is very simple. Let me just get my ink right here and get my little felt tip pen. Okay, there we go. All right, what is a trend? Most important, bottom line foundation of technical analysis: what is a trend? A trend, basically, as it says here, an uptrend is a series of higher highs and higher lows. What does that mean? Well, if we have a low here and the market went from, say, 100 to 110 and then down to 105, you had a low, a high, and then if it went from 105 to 115, you have a higher low right here. So essentially what the process is once you start developing these higher highs and higher lows, that starts establishing a trend. Now, if the market was going down in a downtrend, and then you have this occur, that doesn't necessarily mean that that's a trend up. That could be a correction in a trend down. What would establish the trend to turn from down to up, we would need to see the market come down again and then up again, where you would start establishing multiple high, higher low, higher high, higher low, higher high, and that would start establishing a trend. So depending, if you're looking at the market from zero, you have to also look at the past and what the past data is telling you. And in this example right here, this example, it's telling you that the market was going down and that you're getting that, starting to get that process of the low, the high, the higher low, the higher high, higher low. And as that continues, you're establishing a trend. So, and this continues to create these higher lows. So this is a series of higher highs and higher lows, and that defines an uptrend. Conversely, a downtrend, you have your high, your low, your lower high, and your lower low, or LL, lower low and lower high. So what you're doing is you're establishing a trend down or a downtrend. Now, typically when you're looking at a trend, the lower high does not exceed the prior lower high. And each low goes below the prior low, as you see here. So when the market makes a low and then comes up and makes a lower high and then makes a lower low, it needs to trade below that first swing low to start establishing continuation of that trend and establishing the trend. Now when the market does retrace up, it has to stay below this low and then continue to make new lows. So you're establishing what we call a downtrend. So uptrend and downtrend. Now later on and in other webinars, we'll discuss Elliott wave, we'll discuss the components of Elliott wave, and that is really one of the foundations. If we look back at the old technical analysis, it all started with the Dow theory, okay? Dow, and that's a D, not a P. Dow theory, Theory. And basically the Dow theory said that a series of higher highs, higher lows, and lower highs, lower lows to establish a trend, and that the market should retrace a certain amount. But Elliott came in later on and started putting numbers and retracements and levels and zones and put structure around this theory. So this right here is a foundation of technical analysis. If you understand uptrend and you understand downtrend, you're ahead of the game. Now let me just erase all ink and put the felt tip. Now looking into the future of what we're going to be doing, not really today, but what we're going to be doing is a couple of things. Number one, we always look at this is the move up, and this right here is the retracement. Actually, let me fix the color. All right, let me fix the color here so we have a nicer color. What about that color? There we go. So here we go. So you have your low, you have your high, and then you have your higher low. This right here is called a retracement. Retracement, or it's called a pullback. PB, pullback. So if you hear the term when you're out in the market, because let's face it, we're in iMarkets Live. What do we do at iMarkets Live? We teach people how to make money in the markets. That's essentially the vision. That's essentially what we do, is we educate people how to make money. Yes, we have the signals, but what you do when you're speaking to somebody else, you also tell them that you're an educator. So if they ask you questions, at least you're going to have an idea of how to have a conversation if that person's market savvy. So we look right here, and this is a retracement. And that's what traders basically look for, the retracement. It's every trader in the planet, that's what they look for. They look for the retracement. Once they find the retracement, they look to take a trade. We did that this afternoon. We took a trade. We took one trade, it broke even. We took another trade, and it made a little profit. But essentially, we look for retracements. So these right here are retracements in a trend. Same thing as the bounces you see here in a downtrend. These are also retracements. Okay? And that's what we typically look at. So that is your trend, up and down. Let's take a look at another chart, and let's start identifying some of these trends. Okay, so we established the fact, if you look here, that this market was going up. Should I get rid of the red because now we have red all over the screen? Yes, I think so. Let's take a look and go with blue. So the prior move up was in a uptrend, as you see here. You had a low, you had a high, you had a higher low. So we don't know exactly really what the data was in the past, but establishing the fact that this would be the high, and that would be a low, and then that would be a lower high, and that would be a lower low, and that would be a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, higher low. So what ends up happening is the process probably went something like this. So your trend stopped going down once the higher low was in and started shifting directions back up. Okay, but during the course of this move from high to low, the first thing a trader does is look for the pullback. And you got your lower high, and they look for the pullback, and they look for the continuation. They then look for the pullback, then the continuation, then the pullback, and the continuation. So sometimes pullbacks are pretty, and sometimes they're not so pretty. And sometimes they're simple, and sometimes they're complex. Okay, this would be considered a complex pullback. This is basically a simple. A simple pullback would be, here's a move down, and here's your pullback, your retracement in a trend. That's a simple one. A complex one would be, here's a downtrend, here's a bounce, here's a failed test to try to make a new low, here's a bounce, and then a continuation. So this is a complex, and this is a simple. And this right here has to do with that Elliott, and so does this, essentially, and the Dow theory. So if you look here, that is exactly the same. That's a complex retracement as opposed to this one. So two types of retracements, and that would establish this is what a downtrend looks like. High to low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and continue down. And then the process of changing from downtrend going back up, you would have a low, and that should make a lower high, right? Because you're still expecting this to come lower, but it puts a higher low and starts the process up, and then the next move down, and then you're starting that trend going from down to up. Okay, just like you saw here, same process. So sometimes it's pretty, sometimes it's not so pretty. But at least we understand what a trend, a downtrend in this particular instance looks like. Next. Okay. Now, an uptrend. What is an uptrend? Well, this may have come from down here, so if we say that this is a low, and this is a high, and this is a higher low, and this is a higher high, and higher high, higher low, higher high, higher low, higher high, and this is establishing that uptrend process. And that's what's happening actually right now with the markets, because this is current day market right here. It actually went and tested way up here already. Or it did that. Okay. So looking at the complex as opposed to the simple, let's just look at that again. All right. Here is a complex wave where you have your high, and then you have a process like that where the market doesn't just come down and go up, it comes up and then down again and then up again. And sometimes you see the same process like this, and you could see that. You're just following the structure of the market. But as long as new highs are made on every advance and higher lows on every decline, that's establishing an uptrend. And here's these little complex waves is what we were looking at right here. And you can see that happens a lot in the market. It happens an awful lot, which is actually good for traders. We like to see those patterns. So that's establishing an uptrend, and that's what the market looks like. That is the S&P E-mini futures. Let's take a look at the next chart. The S&P E-mini futures again, and this is going back several years ago. So I was just picking some stuff out just to point it out. But let's think. Let's see what we got. We have a low. We have a high. We have a higher low. Higher high. Higher low. And you could just see the continual advance of new highs on every push up and the higher lows on every push down. So what we're doing is establishing an uptrend, and traders like to what? Buy the retracements. They like to trade the retracements because that's where all the money is. It's buying the retracements. All right, and this was written about 100 years ago. All right, and here's another one. Although it still made higher highs and came down, it still was above that prior low, so that remained and kept that trend intact. All right, so the retracements come in different ways. They look at different. For instance, here's a little complex wave as opposed to this one, but the fact is it's maintaining that trend, those higher highs and higher lows. Okay, that's considered an uptrend. We're still looking at that. Let's look at another one. And I just want to go through each item, trend, range, price action, and then we'll look at Elliott, and then we'll have you initial structure to work with. So that way next week when we come back, you'll have an idea of what we did this week, and then next week we can review what we did this week a little bit and apply to what we're going to do going forward. So let's look at an uptrend again. And to be honest with you, a vast majority of the people in the markets don't understand that that's up and that's down. The only difference is you have those little waves in there, which it makes it an up and down trend. But a lot of people don't even understand this basic concept, and it's the most important concept in trading. So here's your low, here's your high, here's your higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So that's establishing what we call an uptrend on that particular chart. In this example, there's a complex wave. And the reason I mention them is because we're going to have them in the future, and I'm going to get into that very deeply. So you do want to start, I want to start planting stuff right now to you. That way later on, when you look at it, it will make sense to you. That's a simple retracement. So you have simple as opposed to complex retracements. And as I said, traders, most importantly, look at these corrections, these pullbacks. So it's called pullback, it's called retracement. In technical terms, based on the Dow theory, which is a book of like 500 pages, they call it a secondary trend, which that's something from the 1920s. We don't have to worry about that. We'll just use modern day English. How about that? Okay, so now we understand what a trend is. So you have two things. You're either going to have expansion, like you would in the summer. Everything expands when heat expands. You have expansion, or you have contraction. You have range contraction. Okay, when you have contraction, makes the market a little bit tougher if it's an extended or elongated contraction as opposed to a continuation. And I'm going to get into that in a moment. So what is a range? A range, basically, you're establishing a high and you're establishing a low based on prior swings. Okay, you're establishing a range high and a range low, and the markets usually stay confined within those ranges, and they start developing this sort of like a sideways, what we call a sideways line, just like that, where you could take a line and draw it through all through the bars, and you could see how many times prices trade through that. And a lot of times when you get in this type of environment, it makes it very difficult for traders because you don't know. It looks as though it's going to break to the downside and shoots up. Then it looks real bullish and it's going to go to the moon, and then it fails back down. And it's the time that you see it come down here and you think, it's going to go up, and you buy it and it goes straight down. And we saw that happen the other day. I think it was Monday or Tuesday, where the market, it was Monday, where the market had been going a long time for weeks, and then suddenly on Monday, market went down. You could tell a lot of people decided they want to buy it, and it flushed with fierceness to the downside, and it, what we call, trapped a lot of people. And when it flushed everybody out and they got out, it ran them back up. So in a trading range, it can be a real roller coaster ride, and this is what it looks like. So that's called a trading range, and basically you get testing and you get price bar overlap. There's two types. For instance, here's what a range would look like where the market's doing this. Price bar overlap is after the market has made a rally, each price bar would start to establish a sideways consolidation period. And if it's a trend up, this is what we call that pullback, right? You would get these multiple bars overlapping, or what we call price bar overlap, or a flaggish pattern for continuation. That type of range is different than this type of range, as you see here. So I'm going to show you some, okay, I'm going to show you some examples. All right, where would we establish our range? All right, we could see right across here, here's a range high. We can see right across here, here's a range low. We can see right across here is a range low. And we also have some stuff up here. So when we start to look at this chart, this is the most difficult type of market to work with. And you see it just goes and extends over days, all right? And because it's erratic, the market doesn't know where it wants to go. It's basically just zipping around like a pinball in a machine bouncing around with no particular direction. It's a directionless market, and when you have a directionless market, risk goes to the moon. And believe me, I've entered in and you get stopped out because it fakes you. It makes you feel as though it's going to trend down, it's going to break, and because it's still in a range, it snaps back. And every trader on the planet has to gets in this kind of range, and sometimes they get excited that they're going to buy it because it's breaking out and fails. And it's just a game. You don't know. Honestly, you don't know, but you can establish these range highs and lows, but you don't know the time when it's going to break out to the upside or break out to the downside, or it's going to fail. And that's the risk you have to take if you want to maybe take a trade. For instance, if the market came from this high straight down, it makes you feel that they're going down and they're going to continue lower, that they're forming a pattern for continuation. And what happens? It fails back up. This happens. So understanding what a range is, and that typically when you have a range, it's the most hardest trading environment, and that you want to identify this going forward in your own trading of, is the market in a range or is it in a trend? Typically trends are the easiest and best ways to trade. A range is the most difficult. All right. Here's another one. This one was on the 8th and 9th. Okay. You could see here. All right, so you're looking at the market and you're seeing this erraticness, and you're saying, how come you don't have any trades? You're saying to yourself, we all say that, there's nothing happening. Why? Where do you buy? Where do you sell? Do you sell here? Do you buy here? Do you sell here? It's just a spiky environment. As you can see, these little spikes, these are erratic movements in price, which really do not allow for profitability. It's the type of market, if you were to say you wanted to short it here because it's so fast, by the time you enter, it's here. By the time you look to get out, you're here. So this is a range, and I cannot stress it enough. You have trend and you have range. When markets contract, you have expansion and then you have contraction, okay? Markets end up doing this until they expand again, and then they contract and then expand. When you have this type of environment, just you have to be aware of that. So that's called a range. Now, this actually was part of a larger range up here, and you can see the market gave a nice shot to the upside, make it feel like it's going to the moon, and whoever bought it got stuck all the way back down, and whoever sold them got stuck on the way back up. So that's something to always pay attention to, what we call a trading range. This is an hourly chart of the S&P E-mini futures, and you can just see how the market acts in these tests. See these little tests? Okay, and that was actually that picture that I was just showing you, where it becomes erratic. It snaps out and then snaps back to the highs, and that's the type of market that you want to be aware of. A non-trending, rangy, spiky type of environment says to you either A, if you're going to buy and try to buy it here, you have to use a wide risk, or don't do anything. Or if you're going to short them, you have to have a tight stop in case it snaps back up to you. All right, but most times you'll see a range have that price bar overlap, or that sideways line. So let me just show you. So if I take this line and come right across, you can see how many times the price is traded through it. All right. So that's a trading range. When you could take a line, stretch it right across your charts, and you could identify many different times over many different periods. Look at this. This is actually since December up until even yesterday, how far this market has gone. It's gone nowhere but sideways and trading through that one sideways line. That's a sideways line, just like that. All right. So that's a note you want to make. So if you ever hear the term sideways line, you know what it is. Now you know what a trend is, and now you know what a trading range is. See, in a trading range, there's no definition of direction. You could just see this. See, so you could not tell if this is going to be the low, if the low was here, if it was down here. there's no way to tell because the market's erratic. Think of it as a ping pong, not ping pong, pinball. Okay. Okay. The next one we want to look at. I'm not going to make this a long webinar. I'm keeping this to the point, and that way we can establish our first little video and first webinar that's going to be the foundation for going forward. So a couple of things that are important, that are very, very important to technical analysis, is price relationships. What we call an A to B is equal to C to D. Now, on the website, there's a video I did. It's called Commonalities under the training section. And there's other complex stuff you can do with this, but just in its basic form of A to B equals C to D, I want to show you what it looks like. And this is what we call an alt. An alt A to B, C to D. All right. So what do we have? Let's just say A was at 100 and B is at 90. Or we could just say it's at 46 and 34, right? Hello. But let's just say that the market went up to 130, and this right here was 10 points. So this would tell you that this would be about 120 is an area that you would watch, that if the market came down and related in price here, that this would be an opportunity for you to trade. So when you're looking at the markets, we all have our demo platforms. You have the live educational room that we have up all day long. And for those of you that are in the live educational room, you get to see this stuff day in and day out, and you start to learn on your own and do your own trades. That's essentially what the goal is, to get you to start doing your own things and seeing this and making you a technician, where you basically, if you can understand this, you could feed yourself for a lifetime. I hope you understand that. So if you understand this, the basics, and you start to build upon that, you could feed yourself for a lifetime from the markets. Okay, it doesn't matter what any other kind of business you're in, anything you're doing. When you're receiving an income from either the markets or someplace else, you could trade it and create your own cash flow. That's the beauty of what we're teaching right now, and we do that every day. So you have your A to B, C to D. So you're looking for price relationships, equality between here and here. Also what we call an alternate wave equality. That's all it is. Alternate wave equality, where the market trades from high to low, from point A to point B, and then from C to D with the roughly, okay, how do I get it? With roughly the same length. All right. Now, if we take this, I got my dot there. Okay. Now, if we look at this in terms of an Elliott wave, all right, which we're not, and you say, okay, how does this structure really work? If we're looking at higher highs and higher lows also, here's your low, here's your high, here's your low, here's your high, here's your higher high, right? Here's your higher low, and here's your higher high. Now, I want to take it one step further. In the Dow theory, which we'll get to at some point, I'm going to go more into trend in the future. What it does also say is you have these higher highs and higher lows. Those are intermediate type of swings, and within that you have minor waves. So within the larger trend, you have smaller trends also making their higher highs, higher lows. So if you're looking at it, you're saying to yourself, okay, from here we should trend up, and you're still looking at these little trends, opportunities, all right? And then when you do get that pullback, you can relate it to the last largest one, which is this. Something we look at all the time. It's a lot of traders look at this when we're looking at Elliott wave, when we're looking at retracements. Those of you that like to look at Fibonacci, you take your low, You take your high, you put a retracement. Let's just say it's a 38% retracement. Okay, for those of you like Fibonacci. So if you start looking at a retracement zone plus your commonality zone of your price relationship, you start to work and develop yourself an area that you could feel confident that when the market gets there, you could buy it. Okay, and you know where you could put your risk points. Let's go to the next slide. Here's another one. As we discussed, here's a high, here's a low, here's a lower high, and we got that process of the trend down, right? Now we want to start looking at, and here's your little minor waves. Now we start looking at relationships of how to identify areas that you would look at as a trader, what are most important. Yes, it's great to say, yes, Chris, higher highs, higher lows, but where do you buy? Where do you sell? All right. So if you were trading this, and even if it went here, you may not have a complete signal because you didn't really have a relationship or a spot to watch. The only thing you could think of is maybe risk here if you're shorting here. Shorting means you want to buy it high and sell it lower, make a profit. Going long means you buy it low and you sell it high to make a profit. So what traders do is they like to look at these commonality zones where from A to B, and I can't see exactly this, let's just say this was 10 points, and you have a 10-point retracement here for C to D, you could feel comfortable that this is a very good area to watch, and you could put your risk quite a bit higher and feel safe that once you enter, you have higher odds to win than you would to fail. Not everything is perfect. You're not going to win every time. There's times you're going to get in, you enter, and you exit at the same price, or you may lose a tick, or you may gain a tick. But if you're identifying very good opportunities, very good zones, then you can feel more comfortable of a larger move. And that's what trading is, really. You're looking at something, you may enter here, you may get out. You may enter here, you may exit, you may enter here. You exit, it may go against you, stop you out, or may continue, but you're looking at the best areas, and in this case, that's why traders like to look at the A to B, C to D relationships, because if it went here, the last time the largest move was 10 points in a downtrending market, more odds than not, if it goes 10 points, that it's going to exhaust itself, that it's found 100% of that prior move, and that's what we call price relationships. Okay, so it looks something like this. If we draw it out, okay, A to B, C to D. This is what we call an alt bullish. Okay, because on the D area you'd look to buy, so that's an alternate bullish. A bearish, it would look something like this. Like you do here. You see this? The same thing. You have your A, B, C, D, and you have your alternate bearish. That right there, this is an alternate bearish because you're looking to sell it to go lower. We have two types of waves, and this is one of them. This is the price relationships, the alternate wave equality, however you like to call it. That's what we call it, an alt bearish and an alt bullish, or an A to B, C to D. They all basically mean the same thing. And I always say you're always looking for D. You're always looking for D. If you're watching the live trading room during the course of the trading day, and we have a nice volatile market. The market started to pick up this week, which is nice. Now you're starting to get the patterns, and you'll start seeing a lot of these type of patterns just occur. Nice. That's what you look for, and that's where the money's made. You may go for days where you're doing a scratch, a scratch, a scratch, plus one tick, minus one tick, and then you'll get 5 points and 3 points, and then a scratch, scratch, 8 points and 2 points. That's how the market works. You wait for the patterns, you look for the spots, and when they occur, bang, you jump all over it. Okay, but sometimes it just you have to scratch it a little bit, meaning you're getting out in and out at the same price, plus or minus, and you're just always identifying spots to work with. As soon as it kicks for you, then you know you got the bull by the horns, because you know that this is a very, very key area. So I'm just trying to stress that the price relationships are really important. Here's another one. we look at this range right here, the market sold off. But if you take a look at the past, you can line up the equality of an A to B, C to D. Now, does this mean you're going to buy it? Does it mean you're going to sell it? No, you can just be monitoring the market and feeling that, if the market's trading lower, you could say to yourself, well, does this market feel like it wants to go a lot lower? Does it feel like a price relationship? If it loses this area, how far to the downside? But you can monitor spots that equate to prior swings. Okay, and you could draw your lines across there, and that's typically a lot of things that we do when we look at the markets. All this other stuff in between is kind of noise. Now, let's just look at something here. Okay, right here, we could just see, all right, you could just see almost that same type of equality. All right, how about this? This little swing here and that swing, almost literally about the same. You see that? So that would be considered an A to B, C to D, and that's an alt bullish. Remember? Down, up, down, what they call an alt bullish. So we've learned today so far is, number one, we learned what a trend is, both an uptrend and a downtrend. We learned what a trading range is, and we learned what price relationships are. So we've learned the basics, the basic fundamentals of technical analysis: trend, trading range, and price relationships. Because if we look at prior swings and we go all the way back, wow, I didn't know the ink stays there. Okay, let's just stop right here. Now let's look at this once again, and the market goes up and the market comes down, eventually starting that process of the higher highs, higher lows, right? And then it comes down right here, and as a trader you look at it and say, wow, that's an A to B, C to D relationship. Let's okay. That would be an alt bullish A to B, C to D relationship. All right, so it doesn't matter where in the structure it is as long as it eventually happens. I'm sure at some point this one and this one has some type of a relationship, but I'm not going to go count it right now. But you could just see by eye that this one right here and this one right here, these swings were nearly identical. And price likes to relate in degree of trend. All right, price likes to relate in degree of trend. So, which means here's your daily chart. It's a very high time frame, and it's relating in that degree in that time frame. Now, for those of you that are already trading, that understand what I'm doing, keep in mind when you trade, when you go from, say, 1360 and the market has come down 10%, let's just say 10%, okay? Come down 1%. How about 1%? It comes down 13.80. It's up here. When it comes down 1%, it's $15 or $15.80. So if you have a market that went 20 points, for instance, here, say it moved 20 points, not necessarily on these larger time frame that 20 points will relate. What you have to look at also is percentage that the market retraced. So if it's traced at a real low price down here and it's moved so far up, you look at this in a percentage basis, not in a points basis. So for those of you that are traders, just something to keep an eye on and make a note of. But those of you that are not trading yet or watching the signal or just learning, don't worry about it. Okay, here again, this has actually happened just recently. We had the market all-time high, and then made a low. Then the market made a lower high and a lower low, but it's not defining that downtrend. What would have defined the downtrend if this put a lower high and failed? That would establish the trend going from down to up. But in this case, the trend is where? Low, high, and then you have this A to B, C to D. It's funny, I say high. We have a guy who works with us. He does some graphics, and you get him on Skype, and he goes, "Hi, hello." So I say hi. I think of this guy. Imagine speaking to this guy at 11 o'clock at night. Hello. So hi. So we have an A to B, C to D relationship, and in the Elliott wave world, that would also be considered a high, an A, B, C. So although it still has an alternate A to B, C to D, it has a different structure, a different name to it. There's a couple different names you could put, but it's the same thing. All right. But most important, these price structures end up being the same length. So here's a trick also. The market was going sideways for so long, and then it broke to the downside. It gives you that feeling that the market wants to crash and all of a sudden spikes back up. So when you're dealing with these much higher time frames, you have to have a little bit of respect for it also. All right, and we were looking at some other areas when we were watching this on the opening plate video that we put out every day. So if you haven't been watching that, very good idea to watch it. It tells you levels that we're paying attention to. So now we know what a trend is, we know what a range is, we know what price relationships are, and now we're going to go to the last one for the day, and then we'll end with this, and then next week I'll expand on this and go into more complex stuff. So we'll do this also next week. So here's basically an Elliott wave. An Elliott wave gives you counts. You have a low, which is your 0. You have 1, 2, 3, 4, 5. After the fifth wave is completed, you have an A, B, C corrective wave. Let's stop and go back. No, let's stop and go back. Remember, low, high, A, B, C. Okay? Same structure that we have. And if you really want to look at it, you can identify these little higher lows in here. You can't really see it on this chart. It's just such a large time frame. And it was such an extreme move. But if we're looking at this chart, this Elliott wave, the count typically starts at 0, 100% of the time. And then you have your leg from 1 to 2. And as you recall, looking at trend, the trend, this is establishing an uptrend. Here's your high, here's your low, here's your higher high, higher low, higher high. Elliott, R.N. Elliott came in and says, okay, great, but let's put some numbers to it. Let's put some letters to it. Typically, a trend will go 5 waves. What that means is the first one is from 0 to 1. Then the correction, that pullback, is from 1 to 2. And then from 2 to 3, and typically that 2 to 3 leg is the longest leg. Then from 3 to 4, and typically 4 would not retrace more than 38%, and we're going to go into this on our next video when we talk about Fibonacci. And if you look at the video we have on the back of the website called the commonality video, you can see all sorts of stuff on the Fibonacci that I put together, but we're going to review it again on its basic form. And typically number 4 has to stay above number 1. That's a basic form, and that's also quote unquote that pullback. And that's also what we look at is that alternate A to B, C to D. So if we look at this, this would be an A to B, C to D relationship, you see? So everything just works together in a trend. Everything just works together, all the numbers and lettering, and there is structure. So there is, somebody says there's no way to predict the market. Well, nothing's 100%, but it gives you better odds that you can have counts and waves and retracements and relationships that help you understand the market structure a bit better. Now, looking at the harmonic side of the equation, there's the Gartley pattern. This, for example, would be a Gartley pattern. Well, I'm not going to get into the percentages, but basically you have a low, or what we call an X. And it's still within this Elliott structure. If you really look at it, a lot of times it's within this Elliott structure or this this Dow theory structure. It's just that somebody else put their information to it. This guy Gartley basically found something that did like this. And that was it. He found this, he put it in a book on page 222 of his book, and somebody came up and said, wow, it's called the Gartley 222, and here's the pattern. So somebody smarter than all of us decided to do it and created a pattern and sold a book on it. All right, so this is called an X, A, B, C, D. If you're looking at this as a harmonic, in an Elliott structure, Elliott wave 0, 1, 2, 3, 4, 5, after the fifth wave, you typically will get that ABC corrective wave, as I showed you on the other chart. In a harmonic structure, you're taking the X and you're taking a retracement relationship from X to D, and you're also taking a calculation from A to B that also calculates down to D. And you're finding a zone that everything relates where you would enter on a buy and look to trade it. So there's different ways to skin a cat, different names. There's market geometry, there's market symmetry, there's harmonics, there's commonalities, there's clusters. There's whatever name you want to put to it. You can put your own name if you feel like. But the fact is, it's all based on Elliott wave. It's based on price structure, price relationships. And this is going to end our first week. It's about an hour, almost an hour. It's about 45 minutes. It looks actually about 52 minutes. So we're going to end our first week. Sorry, let me get a little bit of water here. I've been talking, I haven't stopped. And I'll put out an email. And next week, we're going to expand on the Elliott wave. We're going to expand and go through all different harmonic patterns. I'll get into some real good calculations and patterns and show you all the a lot of nice little tricks that you could take and use on your own, and help you also understand price structure again. So we'll go through the A to B, C to D's. We're going to go through them. We're going to go through the numbers again. We'll go through the price patterns, and once again and I'm also going to go through these little retracements and help you identify how to look at it like this. So got a lot that we can look at over the coming weeks, and next week's going to be our next part in this series. And with that, I have a 5 o'clock dinner with Bill, our Forex trader. I'm real excited he's on the team with us. He's got himself going Monday and Tuesday, and today it was nice and settled, caught some profits. I'm real happy about that. So we're going to see a lot of consistency from him. I got my focus solely on the futures side, and got a little profits today. So we're going to start picking everything up in that regard, and we're going to be teaching what we're doing more and more, and have a nice, clean, solid model that each and every one you could be proud of and you could take to the market and start building your business, both on the trading side, on the network marketing side, and just have a nice, clean model and keep the vision that we originally put together. And I'm just so excited about 2014. So make sure you're back next Wednesday. Make sure if you can, get into the live trading room, get your signals up, and just get excited. The future is here. The future is now. And I'm just proud of each and everybody. I speak to a lot of you, and everybody has their ups and downs in life. But you know what? So does the market. The market's, although sometimes it looks like it's the worst, it's going down, everything's crashing, it's the worst thing in the world. That's just the time to get started. You know, you have a pile of gold down here, and you're digging and digging and digging, and you feel like you're never going to make it. It feels like nothing's going to happen for you. And how many people quit an inch away from the gold? How many people don't buy the market an inch away from buying it? Okay? So the main thing is just you have to have stick-to-itiveness in anything you do. And with iMarkets Live, we're here for the long haul. And thank you very much. I'll see you next Wednesday, 3 o'clock. Rock and roll. Have a great night. of your website under the trading series, educational trading series. All right, so we have that already put up there in the back office, and we'll just continue to add videos for you along this topic under the market geometry. And last week we discussed what a trend is. And what we're going to discuss today has direct relationship of what we discussed last week. Trend. An uptrend series of higher highs and higher lows, and a series of a downtrend is a series of lower lows and lower highs. And we see this evidence right here. That's what an uptrend looks like, and that's what a downtrend looks like. And remember, you can go back to the prior videos that we recorded, and you could always go through them and advance forward to get your education proper. And we discussed what a downtrend was. We discussed what an uptrend was. And basically, the uptrend is higher highs and higher lows at every high. Well, if I can get this, every high is higher than the prior high, and every low is prior than the higher low. And that is what an uptrend is, or a trending market. Next. Okay, we discussed what a range is. A range basically is when a market is going sideways in a zigzag action. And basically what is actually, if you were in the live training room today, you would have seen what a range is. And I do promote being in the live training room during the course of the day. You get a lot of education. There's not a lot of educating all day long, but we look at different points throughout the day and we educate on what is happening. And today we actually are in a trading range. Today was a range that looked just like this, or actually what you see on your screen right there. So we taught about this. We spoke about it last week. And we discussed staying out of a trading range because it becomes more trouble than not. You can get into trouble, and we don't want you to do that. Then we discussed price relationships, A to B, C to D. What is an A to B, C to D? Basically, you can see right here the A to B, C to D relationship. And this is going to hold true for what stuff we're doing today. Let me see. Oh, look at that. Many times you'll see the A to B and the C to D have an equal type of swing. So when the market goes 10 points here and retraces 10 points, a lot of times you'll find a support type of area. And that's exactly what that is. Now, in a trending market, you'll see many times you'll have these same type of little relationships, and those little A to B, C to D relationships that we look at. And in a downtrend, the same thing holds true. Is you have your A to B, C to D. In a trending market, we tend to look at this, and this works out to be more of an Elliott. And you're going to learn today what a 0, a 1, a 2, a 3, a 4, and a 5 is. And that when we talk about the 1 to 2, 3 to 4, I want you to keep in mind the A to B, C to D. And we're going to discuss that a little bit more in detail as we approach each slide going forward. So keep that in mind. In a trending market, these A to B, C to D relationships are also tied into those 1, 2, 3, 4 and the Elliott wave process. And here's another example. This example, even in the Elliott wave theory, you have your fifth wave up, and then you have your A, B, C corrective wave. Also, this can be considered an A to B, C to D relationship, but when you're looking at Elliott wave where you have 1, 2, 3, 4, 5, and you 0 down here, you'll have your ABC corrective wave, and you're going to learn that today of what that looks like. Now, last week we ended with this slide, and this slide was basically giving you the beginning of Elliott wave and the thought behind it and the structure behind it. Now, typically in an Elliott wave process, you have a 5 wave. 1, 2, 3, 4, 5. When you have that corrective wave process right here, this actually also turns into that harmonic wave, where you'll have what we call an X, A, B, C, D, and it looks something like that. What we call maybe a Gartley or a butterfly or a bat or a crab pattern, which we're going to discuss next week. But we can't discuss this until we discuss Elliott and we discuss the trend and we understand the foundations that go behind these patterns. And today we're going to discuss market geometry, and this is the second in a multiple part series discussing this. Now, I've been doing market geometry for many years, since the late 90s, 97, 98. I started approaching and learning it, and I've had many mentors along the way, and I've read many books on sacred geometry and divine geometry and all sorts of everything that revolves around what we call phi or phi, depending on how you want to say it, PHI, okay? And it all revolves basically around the 1618, which is the perfect number. I'm not going to get too deep into that, or the 618. And this is small PHI. So you have the big one, phi, and the smaller one. And the big one is 1618, and the little one is 618. And this is where everything is revolved around when it comes down to Fibonacci and market geometry and relationships and squares and rectangles. And you can go anywhere in the world, look at plant life, look at the human body. You can look at architecture around the globe from thousands of years ago. You can look at the pyramids. You could look at the stars and the sun and the earth, and however you want to do it, it always seems to revolve around the world's perfect numbers. So even that spiral, that nautilus shell, or just natural spirals, they have their 618 and 1618 relationships, the solar system. So it all comes down to these numbers, but we're not going to get too deep into that. To learn more about that, I did a nice class. It's in your back office under the trading series. It's called Commonalities. It's a commonality video, and it breaks down all these numbers, squares and rectangles and shapes, and it gets more into the relationships and commonalities. And you're going to take what you've learned today, what you learned last week, and you can actually look at what we did in that prior video. It was a couple of months ago. And you can see how everything just ties together real smooth. So I'm not going to keep it, here it goes. I'm not going to keep it confusing today. I'm going to keep it simple, so that way we go step by step. So the next thing we're going to talk about is basic retracements in the market, and what they call, and we'll put quotes around it, Fibonacci. Now, Fibonacci, we have 38.2, a 50%, and a 618, which is the ones we're just going to focus on right now. All the other complex ones we're not going to worry about. There's all these other ones, and there's many different projections and extensions we're not going to get into. This right here, the 70.7, that has to do with the square and the diagonal of a square, and everything seems to work out. But we're not going to discuss that. We're going to talk about basic fib and Elliott, and the reason why is because it's the foundation of technical analysis. You see, if you look at the bottom here, there was a book, and I'll actually give the book. I'll grab it towards the end, and I'll put it inside the room if I can grab it from my Dropbox. It's called the Dow Theory. And that book basically says, and it gives you the theory of the technical analysis of the markets, it says that the market can retrace 1/3 to 2/3 of its gain or loss, many times stopping at 50%. So we're going to look at 1/3, 50% or half, and then 2/3. If we translate that to today's math, basically the Dow Theory that was put together nearly 100 years ago, if we look at that coming forward, And the basic what we have on our retracements on our computers with the modern day charting platforms, 38, 50, 618. And again, we're not going to worry about all these other relationships. We're going to talk about that in the future when we start getting into the harmonic patterns. All right. Also, we have another webinar, a corporate webinar at 4 o'clock. So I'm going to stop this at around 3:50 p.m. Eastern, and then we'll just take a little break, and then we'll come into the other webinar, which you should check. You should have gotten in your email box multiple times. So please look into that. We're going to start that at 4 o'clock. So when the market goes from low to high, we have what's called a retracement, or if it goes from high to low, we get a retracement. And the retracements many times are 38, 50, or 618, depending if it just started at the bottom. If the market's just taken off the bottom, a lot of times it'll come down 50% to 618% before expanding higher. And then it would retrace again, and if it's a very strong trend, it should retrace no more than 38%, max 50% of that swing that it just went up. So this is called the retracement level, and this is going to play part of what we're looking at in terms of the Elliott wave. Traders tend to look at this right here, the retracement. We look at that. Okay, we look at where the opportunity is on a retracement in a trend of where we can enter so the trend can continue either up or down. So it's our job to look at these little squiggly lines and try to figure out where we can enter in with the least amount of risk. Now, in a bull market, an Elliott wave is typically made up of 5 waves. Now, in a very strong market, which a lot of times they don't speak about when you're looking on the internet and you're doing your searches on YouTube or you take classes from other people, they don't talk about the 7th or 9th wave, where many times in a very, very strongly trending market, and I mean a market that goes up or goes down, as it shows here, reverse is true in a bear market, meaning that the trend does this. That many times if you do have an exceeding of that 5th wave and it continues strong, you'll tend to get a 7th and a 9th wave, and this is what it would look like. But most times, this is what you're working with, and this is what we're going to discuss, is the Elliott 5-wave pattern, where the 1 and 3 and 5 are impulsive, going up, and the 2 and 4 are corrective, and even at 6. They're corrective, meaning going down. Now this is an uptrending market, and the reverse is true in a downtrending market where those corrections go up. Okay, it looks confusing. Let's break it out and let's take a look at really what we're looking at here. In a 5-wave market, you have 0 to 1, 2, 3, 4, 5. Okay, you see that pattern. After you have your 5th wave, typically you'll get an A, B, C corrective wave in that. Now each segment of a trend, this is a big primary trend, this is the big trend up, each segment from 0 to 1, from 2 to 3, and from 4 to 5, you will have its own little series or mini swings and have its own 5 wave. The 1, the 3, and the 5 are impulsive, and once you get that first swing up, you then tend to get that ABC corrective wave, which actually becomes that 1 to 2. When they continue up in a trend and you get that second series of the 5 wave, and then you get that one more time, that A to B ABC corrective wave, well, let's think about this. Remember what we talked about earlier was we have this. We have the A to B, C to D relationship like we talked about last week. Essentially, the 1 to 2 and the 3 to 4 are that A to B, C to D relationship. The same as in every little swing on the minor trend, you'll have that. So during the first large swing up that you have, let's just say the market opens and runs up for the first hour. Within that first hour, you're going to have minor swings, minor dips, minor pullbacks into this first hour of the day, and then start to go with that corrective wave process over the lunchtime period. So whether we're looking at this as during the day, maybe one whole day, maybe this, or 1 week, or however long on the bigger time frame, each of those swings have minor series in them of swings. This again was put forth in the Dow theory at the time, and then Elliott came in and decided to put his math around it. Okay, good. Now, wave 1, 3, and 5 are impulse waves made up of 5 waves in the direction of the primary trend. All right, you know what? It's hard for me to see that, so let me go back to the felt tip. All right, which means that's what we have here. 1, 3, and 5 are made up of 5 waves, and here are the 5 waves that we just discussed. Now, waves 4, 2 and 4, 2 and 4 are corrections to the main trend, and they're made up of 3 waves or 5 waves. So here, right here, you see this ABC corrective wave. That's 3 waves. 1, 2, 3, where the upside was 1, 2, 3, 4, 5. So waves 2 and 4, which means this one and this one, or the smaller ones, they're made up of 3 waves or 5 waves. Now, what do I mean by a 5 wave in a correction? Well, if we take a look at the bigger picture, the market has these bigger picture moves. When it stops going up and we have the 5th wave of the 5th wave, meaning that this 1, 2, 3, 4, 5 is completing at the same time of the larger term 5, you start to get the correction down, a much deeper correction. Well, in a much deeper correction, you're expecting a large ABC down, but within that structure, it turns bearish for the period of time where it corrects. So you have that 1, 2, 3, 4, 5, then an ABC up, and then 1, 2, 3, 4, 5 down to complete the larger term ABC. So when the market finishes going up and it's completed its 5th wave going up, and also the shorter term has completed its 5th, and essentially it's completed one cycle straight up from low to high, that first larger term wave, then the larger term pullback would occur, and within that you'll have your ABC corrective wave. But since it's a big, longer process, you may have that series of 1, 2, 3, 4, 5, A, B, C up, and then 1, 2, 3, 4, 5 to get that ABC corrective wave process before the market can start turning up again. So that's essentially what that is saying. Now, impulse wave determine the trend and contain a minimum of 5 waves. Well, basically, this is determining the trend. The trend is up, so that's what it's basically telling you. Now, corrective waves, as we just saw, contain 3 waves. A lot of times, you'll get that 1, 2, 3, 4, 5, and when it corrects, it'll come down sharply and then continue up again, like that. So sometimes you'll have a flush rather than a pretty corrective wave, and that's not out of the ordinary. Now, wave 2 to 3 is typically the largest wave, the strongest wave from here to here in an Elliott wave. And also, it typically will hold 38% of the swing from 2 to 3, and we're going to discuss that in a future slide. And it will hold above this prior number 1 point. So those are the key elements that we want to see in an Elliott wave structure. That wave 2 to 3 is the strongest. On the retracements, it's shallow and stays above that prior number 1 high. Okay, now remember what we talked about in a prior class where we had the A to B, C to D, okay? Essentially 1 to 2 and 3 to 4 are typically similar. So if this is 10 points or 20 points, let's just say 20 points down, this many times will be around 20 points also, give or take. All right, so they'll all be in similar degree of length depending on the trend. A much larger trend will have a much larger wave, and many times it'll be a percentage based, but we're just going to right now for basic purposes that A to B, C to D typically will emulate one another. They'll have that same type of length, and when you see that same type of length, it's something to look at for a trade opportunity, or where you could see a turning point in the market. Now, the Elliott wave structure and Fibonacci retracements are important. All right, Elliott wave from 0 to 1 to 2. So we go from 0 to 1 to 2. Now, right off of this area, this many times is 50 to 618. Well, okay, I'll tell you what. Let me just redo that. All right, it's 50% to 61.8%. Little fee, remember? So off the market lows, it may come down that deep. It may even try to come down a little bit deeper. And that's where you look in for that first higher low. So if you're in the live trading room, a lot of times you'll see me saying, let's look for that higher low to occur. Once we get that higher low, then we can start that process of a trend in another direction. And then the next pull back down, we're looking for that second higher low. All right. So in this example, we look at retracements of 50 to 618 off that first low. When a trend starts to develop from 2 to 3, that becomes the strongest wave, and typically you'll have around a 38% retracement zone and maximum 50% on a retracement. And that's where we start to get that 3 to 4, also known as that A to B, C to D relationship. So this is the structure of that Elliott wave, and then once they have the 5 wave put in, then we'll start looking at that larger corrective process after that. All right, so we're getting our foundations in, and we're going to look at some live charts right now, actually, and we'll take a look at what we just learned. We learned that, and this is a daily chart of the S&P futures, and this looks like it's from December, looks like last year coming into this year. All right, so I was pulling some stuff down and just making some notes. So if we have the 0, and then we have that initial rally, that's that 1. And then the first pullback, as we said, in Elliott, many times 50 to 618. So the market did its first dip and then started its journey much higher. Now you did have an interruption right here, and we could look at that as maybe a minor wave within the continuation of the much larger trend up. And then finally the market got its 3 to 4 wave. And this right here and this were literally almost the same exact amount of retracement. So that would qualify it as a 3 to 4 or an A to B, C to D. The other thing that qualifies it as a good Elliott pattern is it's 38% retracement or less, and that's coming from 2 to 3. And also it stayed above the number 1. So that's a bullish sign on a retracement like that. Now that next drive up put in that 5th wave, and then after that you had that much deeper move down, that A, B, C corrective wave. And within there you had the little minor waves. Okay, you can't really see them here because they're much larger time frame bars. And then the process continued up. This right here is pretty much a perfect Elliott wave pattern if you think about it. It really is, because the structure is right there. Here's another example. So you had your 0 to 1. However, you didn't get too deep of a retracement. That's indicating a very, very, very strong market, that when your first leg up off a low, it has a shallow move. That's extremely strong. That's a telling sign. All right. So your 1 to 2 had a very shallow retracement, but it was 20. Let me just fix that. Okay. It was 20 and a quarter points down. The next relationship, when it went from 2 to 3, had its correction down to 4, and that had a 20-point relationship. All right. I have a program that plots all the swings, and it was pointing them out, so I thought to share it with you. And then on that 5th wave up, then it gave you that ABC corrective wave, as you see. So we're basically looking at defining the Elliott wave process, the waves, so you know what to look at going forward. So if I say we have a trend and we have an A to B, C to D relationship, or we have a 3 to 4 wave, or there's 4 waves coming down and it can shoot up for a 5th wave, you know what we're looking at. Or if during the course of a trading session, the market has taken off and we say, okay, we're looking at that price relationship that we had on wave 1 to 2, or that first pullback, you know what we're looking at. Okay? And then if we say we're looking for that corrective wave process, you know what we're looking at. All right? We have a good turnout today, actually. All right, so here's what I want to do. You take a look at this chart. Let me clean all this up here. Erase all the ink on the slide. All right, so if I take this, and I'm going to zoom in, okay, because we talked about these corrective wave processes within the structure of a trend, right? We talked about that, but the higher time frame has its retracement like that. But if we delve deeper into it, we could see what happened. So the market made its first wave up and then gave that corrective process, that A, B, C corrective process down before taking off higher. Same thing happened after that third wave was put in. We have that A, B, C corrective process before the market went higher, and that prices, as we mentioned earlier, basically emulated each other. When prices meet, when you have a relationship from here to here, it's really important. The market likes to relate in degree, meaning that if this is a smaller time frame, you'll have little waves in here. A much larger time frame would have much larger waves, and they'll have relationships on much higher levels, as you see on this chart. So basically what we're looking at is this chart right here, zoomed in, and we could see that within that process you have those corrective waves, and it's just a natural thing to happen. And I don't care if you're charting sugar, you're charting the S&P 500, you're charting Forex, or you're charting Bitcoin. All right, and Bitcoin got charts. Patterns are patterns of patterns. You can chart the flow of water, the sun, the temperature, and you'll see that chart patterns occur in anything. I don't care what you're doing. It occurs in everything. And it's just for our job to identify this. Okay? Now, going forward into next week, all right, going forward into next week, we're going to have, discuss a little bit in terms of Fibonacci time, because right now, if we look at the low to high, and then we have a retracement, we know that, okay, 38 to 50% retracement, 618. But what about time? See, time is where you separate everything. All right, today the market was completely sideways and we didn't want to get in trouble. Yesterday we caught a trade in the futures, a scalp in the futures, and the market did something like this. And we were in the live trading room and we were plotting out time. All right, we were plotting out time, where time should come in. And when time came right into our zone, those of you that remember, I know Trish was in there, and I think Sean, I see a couple of you, maybe Justin or MB, I see a few of you that were in there. When it comes into time, you have a much greater opportunity of having success than failure because you know that the market's corrected in time. So what we look at is, for instance, let's just say the market went up for 100 minutes. Okay, let's just say when it went up for 100 minutes, and we look at the corrective process, we would say, okay, maybe 38 minutes to 50 minutes it's going to take to correct from here to here. And when it does that, if it's around a retracement level, a horizontal retracement level, it's now exhausted its time retracement and price retracement, and we look for an opportunity for a trade. So the real trick in Fibonacci is not only price retracements, it's also looking at time. Okay, so we could look at all the pretty retracements here. That's great. But the trick is when the markets came up a certain point and we know what the correction of time should be, or at least the zone of where it should be. It doesn't matter if we're entering here, here, or here. We look at zones where to enter and support of where the market should stop going down. And of course, nothing is perfect. Everything's an estimate. But we look at time and price and where to enter into a trade. Okay. So let me just... So in this case, for instance, the market went here to here. If we were to take an exact replica of time, you will see that this time and this time pretty much matched up. A lot of times you'll get from the swings 100% of time should match up. Now let's just say this was 12 bars, okay, hypothetically 12 bars, and this went 12 bars and it was here and it was still correcting, and then it went 20 bars. Well, we have other things that we're going to discuss going forward in terms of what we call overbalancing of time or overbalancing of price, meaning that if price went down to 25 points rather than 20 points and went further than it should, all right, there was a gentleman, his name is Gann, he basically said if time or price takes too long, that's indication that possibly we can have a trend change. But sticking with the thought, if this had 12 bars, we're looking at roughly 12 bars also. The other thing we look at is we take this low to this high and we measure time. So whatever time it took to go from here to here, from 2 to 3 wave, we're then going to measure 38, 50, or 618% of this. So let me continue of where we were. So when we look at the markets, all right, and I know you're going to have to look at this once I record it and I'll put it up on the site. You're going to have to look at this over again, because if it's a little bit too fast, you have questions, you just stop and look at it again. And I'm sure next week we're going to have a ton of questions. So when the market goes from 0 to 1, certain amount of time was spent, and then we look at a percentage just like we look at Fibonacci going forward. The same thing, we look at from 0 to 3. We look at 1 to 3. How long did it take to go from 1 here and a percentage going forward? How long did it take to go from 2 to 3 and a percentage going forward? And how long did it take from 0 to 3 and a percentage going forward. So what it says here is when time zones match, what that means is when we start plotting time, okay, you're going to see they're going to get a cluster from all these different points to the market high. You'll start getting clusters. And when they start clustering up also, that gives you a better indication, because sometimes on a bigger trend time frame, you need to do that. You'll start getting clusters of time along with clusters of price. And that's where we try to identify trend turns. All right. And next is next week. All right. We are going to review Elliott Wave. We're going to review Fibonacci price ratios like we talked about today. We're going to expand on that because it's going to be important to what we're going to go through. We're also going to go into more of price and time, meaning that price sideways, time vertical, and how they meet. We're going to get into that in detail. I just gave you a little taste of what we're going to look at. Now, what's important is we're going to go into the intro of market harmonics, or what they call market geometry patterns. It's the same thing. You could hear clusters, market symmetry, commonality zones, harmonics, geometry patterns, however you want to call it. It all works out to the same. And I can give you an example in a moment. All right, so if I take the bat, the butterfly, the Gartley, the crab, the shark, the cipher, these are all what they call harmonic patterns that were developed by a couple of people. You have Bryce Gilmore. Originally started with H.M. Gartley in a book he had. And in that book, it was page 222. So they called that the Gartley pattern because he figured that if the market did something like this, it had a pattern. So somebody took that, created a pattern, and Bryce Gilmore, who's retired now, was one of the pioneers. Him and Larry Pesavento, Scott Carney, and they've put together these books. These you see them all over YouTube, but I'm going to put it all together for you. So don't worry about that. Don't let the word scare you. And then we're going to look at Fibonacci projections, extensions, retracements. We're going to look at 3 drive patterns. What is that? Well, if we look at a 3 drive pattern, essentially looks like the 5 wave. Okay? The 5 wave is here. But the 3 drives pattern actually is a climactic pattern to end a trend. And what I'm going to do is I'm going to go back here. All right. So if we look at the 3 drives pattern, at the end of a bigger time frame wave, we get these 3 drives. In this last thrust up, you'll tend to get 3 drives. The market does something like this. Real shallow drives up, and that typically ends the trend. So a lot of times you'll see that on the 5th wave of the 5th wave. So like we show here, you have the 5th wave on the first one, 5th wave on the 3rd leg, 5th wave on the 5th. A lot of times you'll get that, and you'll start that larger term corrective process. The Gartley pattern, as we were discussing, you can have something similar to where you have an X here, and it'll look something like this, okay? Butterflies, Gartleys, crabs, something like this, where basically you're looking at this as A to B, C to D, which is it's another way of saying that the market put a high and then you have an ABC corrective wave. So in a bullish trend, you'll tend to get that pretty harmonic pattern, but it's within the context of a trend anyway. And we look at different levels and spots where we start identifying clusters and both time and price. So we're going to get deep into this as we go into the further weeks. You're going to really like what I have in store for you. And every week we're just going to eat a little bit. We're coming into about 3:47 to 3:50 p.m. And what we're going to do is we're going to take a break. And then we're going to go and do the other webinar. And that will happen in about 10 minutes. So I'm going to take about 15 minutes. So let's take a little break. Let's stretch out. And let me go back to the other chart if I can do this. Hold on a second. Okay. Alrighty. All right, let's go back here. And as I said, next week we're going to get into all these different thoughts and ideas. And if I don't get to complete it next week, we're going to go for the week after and the week after. And we're going to keep building upon this until you have yourself a nice methodology that you can go into the market and you can create profits on your own. The vision for iMarkets Live, is for learning and earning. All right, you have your signals, that's fine. But those of you that want to learn, that want to pay yourself for a lifetime, that if you want to wake up one morning and take a trip to Indonesia or take a trip to New York City or travel or sit on the beach. I know there's one of our members, Mark Stokes, he's in California snapping pictures every day from the beach, showing his little trading setup. And we have other people that are doing that. And they're sending me their pictures. That's exciting, knowing that you could be successful from any place in the planet. You could build your network marketing business, but you also could have your trading business, and you can create a profit on your own if you choose to. If your hunger is big enough, if your conviction is big enough for success, for understanding the markets. And the other thing is, the fact is, you want to learn this stuff, because when you're expressing this to somebody else, that you educate people in the markets, that we're an educational company and we help people learn and earn, and they ask you, what's an Elliott wave? And you go, I don't know. Well, what kind of educator are you? So you have to ask yourself, you want to be well prepared, and my job is to prepare you well so you have all the information necessary. And just a little bit every day, a little bit every week, guess what? You know more than 99% of the people that will ever walk into the markets, and you can educate them. So you not only educate yourself, and you're able to create yourself your own long-term lifestyle. I've done it myself. I could live literally anywhere on the planet without IML, without anything, just trading alone. You understand? I've been doing that forever. All right. I want you to do that. The other thing is, I want you to be able to educate other people when they come into the markets and they're excited and they, talking about Forex, talking about futures and learning and trading. Sure. The last thing you want to do is say, well, I'm just on the signal. No, educate them. But that's up to you. It's your business, your own independent business. But the dream and the vision of when we started this was educating people to educate people, and teaching people to have their own independent lifestyle, multiple streams of income. You have the network marketing income. You have your trading income. You can have your signals income. All right, we got other great things to come. I'm going to be talking in the next 10 minutes on the corporate call, and check your email. I got some stuff we're going to talk about going forward. We're just getting started, and get excited. I will see you back here next week. I'll put the emails out in terms of the trading education, but we'll go through this next week. I got some good stuff to include, and we'll keep building on it. Once this video is uploaded, I will shoot it out to everybody tonight in a link that it's been uploaded in your back office, and you can take the time to look over it among your leisure. Have a great day, and thank you so much for being part of this. Okay, so it's a continuation of the market geometry that we've been looking at. Now, originally I was looking to do this as an extended webinar to go 1 to 2 hours. But then I realized the amount of work that's going to be involved, and just having you guys sit around for all that with all the charting, I think would be way too much. And especially if somebody's going to watch this as a video, it'd just be way too much overload. So I'm going to break it down to, today we're going to look at more of theory of the patterns, and I'll draw out some of the numbers and how the patterns work. I'm going to show you one chart, and I'll show that on, I believe it has a Canadian dollar. I'll show you what it looks like on a particular chart, but most of the work, pretty much 99.99% of the work, is going to be us drawing it out and getting the numbers and behind all that and the pattern and what it looks like. So I think that is going to be the best route. And then next week we could do another webinar and expand on what we did this week, looking at actual patterns. But I just wanted to go through all this. So Market Geometry 3, in the past couple of webinars, we had went through trend range, we went through Elliott wave, went through some relationships, A to B, C to D, price relationships. And we're just going to continue to expand on a few things. We're just going to review Elliott wave real quick. review the Fibonacci ratios, price ratios, whether it is a retracement, an extension, a projection. We're going to go through that. And then we're going to go through the intro to market harmonics, or what they call market geometry, using the XABCD patterns, which essentially also people look at them as the bat, butterfly, Gartley, crab, cipher. I didn't include the shark. It's kind of a wacky pattern, so I'm not going to include that. And as I said, Fibonacci projections. And then we'll look at the three drives pattern. I'm going to keep it not so intense and not so long today. Enough that we could capture some information. We'll go through it step by step. And when we get through all the different patterns, then I'll upload it to the website. You get to look at it for several days. And then next week, we'll go into actual charts of everything that we discussed today, each pattern individually. So I think that would be a better way to spread out the series of webinars. So let's continue. And Elliott Wave. Let's take a look at Elliott Wave. In the past, we discussed that the market has a low, which will be a 0 point, and you have your 1, your 2, your 3, your 4, and then your fifth wave. So typically an Elliott wave would have 5 waves. From that, you would have traditionally an ABC corrective wave. Within the ABC corrective wave, many times you could take this fourth swing, this last pivot, and consider that a base to work from. And then on that ABC corrective wave, that actually looks like a harmonic pattern, something that we would call a Gartley or a butterfly, a Gartley pattern. Yeah, butterflies, you have bats, you have crabs. So this is more of either a bat or a Gartley type of pattern. And I'll get into those a little while. But on a typical Elliott wave structure, the 5 wave would have typically your ABC corrective wave. Unless you have a very, very large fifth wave, and then you have another fifth wave of a fifth wave, like we discussed last week, a much larger time frame. And in that case, this retracement would look a whole lot different. So just keeping it basic, looking at right here, if we're looking at the Elliott wave structure, that ABC can actually be an A. This could be an X, A, B, C, D pattern also. So when you're looking at harmonics, you also have to look at the bigger picture of where in the overall structure of the trend that you are. And always looking for the D point. Now today I was looking at a couple of patterns in the afternoon, and the market was just flying so heavily from the FOMC. They moved so fast, so nothing was clean. It was kind of, I was looking to see if we had any patterns I could bring and show you today, but nothing was clean enough. So let's go to the next item. I'm just going to go through this again, the A to B, C to D relationships. All right. So this is called impulsive, when you have an A to B, then a retracement from C to D. So you would have, this is actually called, many times this would be called a measured move, where your A to B is equal to C to D right here, meaning that if this is 10 points, that would be 10 points, or a derivative of 10 points. But they typically call this a measured move or an A to B, C to D, and this would be considered an impulsive A to B, C to D. Now corrective is what we just saw, is this retracement down in a trend up. So obviously this is coming from down here, like that, something like that. So where you're having your retracements in a trend, these are corrective A to B, C to D. So when somebody says we have an A to B, C to D pattern, well, you have to ask them, is it impulsive? Is it corrective? Is it going as a measured move, or is it just a retracement in a trend? Now, obviously this also can be a retracement in a trend. If your trend is so large, you can have something like this, where somebody would look at it as an A to B, C to D, but yet it's a retracement in an overall trend. that's a different story. All right. This would be if you were coming out of a range or you're coming off of a swing low in a higher time frame. So just keep it simple. When you have such a large move down and you have this corrective wave, it could be misconstrued as A to B, C to D, or a corrective A, B, C off that fifth wave like I just discussed in that prior chart, which we can go back and look at this one more time if I can get there. If you see what I'm talking about right here. Okay. So some people would look at this as an A to B, C to D impulsive, where it's just correcting of a larger term trend. So something to keep in mind. Okay, now in terms of retracements, and again, this would be what? An A to B, C to D corrective. Okay? And retracement levels, the market typically retraces 1/3 right here to 2/3, many times stopping at 50%. So you would have a 38 to 50% retracement of the move from low to high. So these are your retracement levels. Many times you get that type of retracement. Now, as we discussed in the Elliott wave, for instance, your low, you have your first pullback, the second pullback run up, and that pullback should not exceed this swing, this high, or 38% retracement. So many times you'll get that 38% retracement, and also it would match this A to B, C to D. This leg right here would be that equivalent. All right, this leg right here at the low, when it first comes off of a swing low, when the market first comes off of a swing low, you're more likely to get a deeper retracement because it's trying to make a retest down and it's failing to do so, and then it starts to drive higher. So the first retracement down off of a market low is deeper typically than the second run up and that second retracement. So we also have 707, you have a 786, and you have an 886. All right, on our website, we have a video called Commonalities, and I get deep into how you can arrive at 38%, 50%, 618%, 786, 886. So not to go into all those details, best just to go on the website, look at the video we did on the commonalities, and you'll see how we arrive and where the 786, 886, 707, 618, and 50% and 382 retracements percentages come from. So typically a 38 to 50% retracement right here is considered a shallow retracement, where a deeper retracement goes down 886 to 618 right here. So a shallow retracement is 38 to 50%, where a deeper retracement, you would have a rally and then maybe a little dip, and then it comes down this far before going up. That would be considered a deeper retracement as opposed to a shallow retracement on the first move down. And basically we have it all marked off over here. So that's a retracement in a trend. Okay, now projections of what we had just discussed, where you have your A to B equals C to D. Now the trick is, here's a percentage. The question is there a key resistance up here somewhere that the market is watching? And in that case, your A to B may be 10 points. And then this may arrive at a 618, or say 6 points from this low to here. Okay, so maybe an A to B times 618 equals that CD leg, you see? Not always you're going to have a complete measured move up. Many people in the markets think that you would get a complete measured move up on an A to B, C to D, when that's not really the truth. you have to look at these derivatives also and how they also relate to another part of the market. For instance, let's just say the market had sold off, all right, and you have some resistances up here like this, all right. So the market decides it's going to run off the low, come down, and come up again up to this area. All right, and we know that this was 10 points, and this is maybe 8 points. So we would be watching 80% or the 786, 886 of this whole swing. So rather than going 10 points, you can start watching resistance up at an A to B times 786 or 886 of this last swing, and therefore you're getting that relationship. Other things you're going to look at would be the high, the low, and then your retracement levels. Let's say this is a 38% retracement level from market high to low. Okay, from here to here, let's just say it's a 38% retracement, but this here was 10 points down, up to this point is around that 8 points. So again, you're still looking at that A to B times 786, 886 would equal that C to D leg, you see? So you want to be careful when you're looking at this, because a lot of times in books or out there in the marketplace, people call that a measured move. And although, yes, typically it's called a measured move, it's not really a measured move all the time. Sometimes you'll fall short, maybe a 618. Now, what if your 38% retracement was up here and this was 14 points off the low, off that swing? Meaning that this right here, let me just draw this out. This right here, this swing was 14 points. This was 10. It would still actually qualify as A to B, C to D, but it would be A to B times 141% equals C to D. So although this swing up is much larger than this first swing down off the low, that still qualifies it. So this is what they call a projection. All right, a projection. So typically, as I said, a lot of times you'll see that as 100%. Sometimes it falls short, sometimes it's further. It all depends where resistance is and what. And hold on a second. All that talking. And it depends where all the prior resistance is and retracement levels, where you would get those A to B, C to D projections up. Now, given the fact, let's just say that the market also, let's just say this is an all-time high, and now the market is making new all-time highs. Well, there's no limit as far as it can go. I mean, there really is no limit. We've seen this before, where a market can continue. So if a market is in an impulse going strongly up, when you look at projections, you're not looking at areas where you would short. You would look at targets where you think the market can go. So yes, if you had the same condition, this would be 100%. That's typically where you would first want to look at. Once it starts exceeding that, then you can start looking at these other levels. But keep in mind, if the market is at a new all-time high level, you don't want to fade that. All right, you're just using these projections as areas. If you, let's just say you bought the market and you wanted to get out someplace higher. Okay. Now, what's an extension? Let me draw this out for you. An extension is basically you take in B to C right here, and you're extending it up. So meaning from this point right here, A to B, that's your impulse, okay, that's your up, and then from here to here down, let's just say this is 10 points. So an extension is A to B times, this A to B right here, A to B right there, times a percentage. So times, let's just say 1618. 1618, you would look at roughly 16 points up on this move from C to D. All right? Or C. I'm sorry. Let's get rid of this. Here, here, here. So A to B is 10 points times 1618, which is 16 points. That would be considered an extension. So just like you have a projection from here to here and from here to here, this swing down also qualifies and is an extension. And you'll see how all this plays out when we start looking at the harmonic patterns, how it all comes together. All right, so let's take a look one more time. So market runs up 20 points, comes down 10, and then starts extending up, and we look and we say, okay, it's a 1618 extension, and this is the area to watch, and how many points that would be? That would be 16. All right, so that's an extension. All right, so let's look at some commonality zones and how we start to look at this and start to tie it all together. Now this looks a little bit confusing, and I'm sure it is confusing if you don't understand it. That's why we're going to break it down piece by piece. So the market, let me draw this out with my arrow. Market went from low to high, and then you had a retracement. Then it went from that low to the next high, and then you had a retracement. It went from that low to that high, and then you had another retracement. Well, a couple things we look at. Let's just say we're starting with this area here. So if we take this area to this area, we look at and we find a retracement, that's fine. But if we take this low to this high, we look at, say, a 38% retracement. If we take this low to this high, we look at it and say we find a 618 retracement. And what that does is give us two levels of commonality, because the larger swing, let me just draw this up, the larger swing is a 38%, and the smaller swing is a 618%. And they both land right in this general area, and we call that commonality. So in this next example that we have drawn out, you could see here, from this low to this high, down 38 to 50%, and from this low to this high, down 50 to 618%. So you have commonality in the zone. So that's the first thing you would look at, is where commonality is. Where is support? The next thing you would look at is your extension or your projection. So how would you find support here? Well, the first thing we would do is look at this swing down versus this swing down. Maybe this is 10 points. Maybe this is 10 points that come into this area over here. The next thing we look at is this swing up. All right. And then we look at that swing up versus this swing down, that extension. So you have retracement, you have the projection, and then you have your extension, you see? So they all work together hand in hand in finding areas of support and resistance. It just takes a little time for you to draw it out when you're looking at charts. All right, so let's look at this again. So we're identifying that retracement. We know that the last swing down is based on this swing down and this swing down, right? This whole area is the same as this. And the two things we look at on that retracement is on that A, B, C down, we look at the high to A, and from B to C as that projection. And then we look at A to B with the percentage down, gives us that extension. So basically we look at areas that you want to look at as support, and you could tie all this together. Now, obviously is on paper and it's theory, and it's a lot easier if you're not physically drawing it out. You're just marking it down on paper. When the market's moving, you have to be on top of this. All right, so something important to watch. We're going to start seeing a lot of these type of patterns as the markets progress now into the year. These patterns are going to start opening up across all the markets. We just started the new year. We're still into the first couple of weeks, and we're starting to see the markets open up. You know, during the winter, into the new year, they close up for the last month. in that first month they start opening up again, and then you have a nice run of patterns throughout the course of the year, and that's what we're starting to see. So this is really important now because you're going to start seeing a lot of these type of patterns, which they're already starting to do. All right, so it's very, very good to start practicing commonality zones. Now, how do we tie in commonality and harmonics is important also. Where you have a low, you have a high, and you have a retracement. That's that retracement zone. The same chart here, low, high, and retracement. Now the trick is you want to put in those harmonics. So let's just stop a second. Let's go back to the prior slide. And if I was to take this low and we would start drawing in those harmonics, you can see how all this starts to work out together. You see that? All right, so we're going to start looking at how they kind of intertwine, market harmonics intertwine with basic market geometry in terms of retracement. So market geometry is typically, as I said earlier, we have X, A, B, C, D. You're always looking for X and always looking for D. The larger structure is what? This whole retracement down from A to B, this whole retracement down, you're looking for where support can come in. Commonality from this low where retracement is. So if we look at it on a harmonic type of level, we take this swing down, we put this first rally up, pull back down, rally, down, and then we start looking at this in terms of levels of what percentage from X to A, what percentage from B to C down to D, and we start connecting these zones, and we start creating these harmonics, whether it's a bat or a Gartley, and they come into play also. So there's two types of work in one, where you have basic market technical analysis from the early 1900s. Then you got the Gartley, and you got all these other type of patterns, these harmonic patterns, which tie into that. So they all work together. And a lot of it is based on the Elliott wave. If you really think about it, if you look at the work we've done in the past several weeks, a lot of it is based on Elliott wave due to the type of patterns that it has. All right, so I drew it out again, as you could see here. So we got the harmonic Gartley pattern. And that's what it would look like, drawn in. Okay, I'll drink some water. All right, so next pattern, next thing we'll look at is we're going to look at the Gartley pattern and what it's supposed to look like. So everything starts with a X, then we go to A, then we go to B, and then we go to C, and then we go to D. Now, I'm going to draw out this pattern, I think the next pattern, but let me just stop for a moment. Let me stop for a moment and show you on, say, a Forex chart. I didn't mean to do that. I didn't mean to do that either. All right, let me fix this. All right, let me just show you on this particular chart here. All right, so when you're looking at charts themselves, this would be considered an X, A, B, C, D. This would be considered a butterfly pattern. All right, so we're not going to get into this right now in the actual physical charts. I want to go over more on theory on what it looks like. I'm not worried about all these crazy price bars right now, because if I don't get you the actual patterns and the understanding of them, then we're not going to make much sense here for you. So let me shut that off. Excuse me. Can you believe it? Here it is. There we go. Okay, let's go back into the Gartley pattern. Let's go back into the analysis of that, and let me put on my full page again. There we go. All right, so we're not going to get into the actual charts tonight. We're going to go through the theory, and then next week we can go through the physical charts, but I was just kind of showing you what it would look like on a chart. So what do you guys see here? Let me just make sure we're seeing the same thing. Okay. All right, so on a Gartley pattern, and we're always looking for, on market geometry, X, A, B, C, D. Market geometry, X, A, B, C, D. All right, that's market geometry, and then you have harmonic patterns that go with it. Basically, as long as your geometry works, it's fine. Okay, so on a Gartley pattern, your X goes up to A. You have a rally from X to A, and then your first retracement down, which is this is your B, should be a 618 retracement. So this area right here is a 618 retracement. So this is a 618. So from X low A down to B is a 618. Now going from B up to C, the market should be a 382, 886. So this area right here, from this market low, from the market high up, that retracement up can go anywhere from 382 to 886. What that means is, let's just say it stops here or stops here. Anywhere in here, if it stops and turns down, that still qualifies the pattern. And then when the market goes from C down to D, that's that extension. That's that B to C down. That's that extension we were looking at, and that's that 1272 to 1618. So the market extension goes from B to C down to D, a 1272, 1618 of that B to C. Okay? And then right here, 786. So Gartley should not go more from X low to A high past 786 into the D pattern. And that creates a perfect Gartley. That would be a bullish Gartley pattern. So if you recall, when we were looking at the trend going up, so you got a trend going up, and then it makes that A, B, C corrective wave. Well, you can look at it in terms of that Gartley pattern that we're drawing out right here before it continues, you see? That's one way to look at it. Off a market low, this would be a second way how to look at it, where this would be the base, and the market would take off. So you're always looking for D, always looking for X. So X up to A is a 786 retracement, but the criteria is that first swing down off the high, and that A to B, C to D wave is a 618, and then you have that 382 to 886 swing up from that A high, B low to C, and then on the way down you have a 1272 to 1618 extension from B to C. Now they don't take into consideration the A to B, C to D wave in terms of length. They don't take that into consideration in the Gartley, where maybe this is 10 and this projection is maybe a 1272 of it, but they don't consider that. That would be a Gartley pattern. Now this is the butterfly. That's what I was just showing you on the other chart, but I turned the chart off, where the X pattern, and let's look at it here, the X pattern was here, and the market sold off down to A. Now, on the way back up, on the butterfly pattern, your X to B, this is a 786. 786% from X, A, up, B. So 786. I know my drawing isn't the best here. And then from A low to B high down, you're looking at a 382 to 886. So there are some spaces or variables where the market has room that can go a little bit deeper or a little bit shallower, but as long as the harmonic pattern is available and working in it and the structure is there, then it's fine. Now, the main thing with this butterfly is this next swing up. All right, so you got your B to C. Now this is a 1618 to a 2618 extension. So from B to C up to D, this is your criteria. So the criteria is you're taking B to C and you're multiplying it by 1618 to 2618. We're also taking the X high, low, A, and then measuring up a 1272 to a 1618. All right, so you're looking at that on the way up also. All right, hold on one second, gang. Hold on one second. All right, so we're just going to go through the patterns here, and one step at a time. Let me just get my pen is not working. All right. So basically, this is a butterfly pattern, and that's kind of what you're looking at. You're looking at the market swing up. You're looking at this swing up. You could look at this swing up if you choose to. Anything that where geometry works, where the market has geometry, then you could tie it all together. And as long as you find some commonality, essentially, as long as you find some commonality, that's really all you're looking for. You're looking for all that commonality to work. All right, so where in a trend, if this is going like this, you would look at a retracement zone. Well, where's that commonality off of these swings? It's the same thing. You're looking at this just a little bit different of a way compared to how you would look at it in a straight trend up. Okay, the bat pattern. Bat pattern. Okay, now the bat pattern is similar to a Gartley pattern in that this X down to A up to B is a 382 to 550%. So from X down to A up to B, it's a 382 to 50% retracement, and that should stop it right there. On the way back down, it should hold a 382 to 886% of that market swing up. So from A to B down, you can get a 382 to 886 retracement of that swing. So as long as this criteria now is holding, we then now look up at this criteria coming up into D. So D would be an 886 of the X A up. So let's take that little swing here. Down here, up 886% of that swing. And that would be your bat pattern. Now, your B to C to D would have that same 1618 that we saw in the other pattern on that butterfly to 2618. So B to C up to D, and then you have that X A up to D, and then you have the BC up to D. You have all this put together, has your areas to watch, and that's your bat pattern. Similar, like I said, to Gartley, except that Gartley comes in at about 786. This comes in a little bit further, and I guess somebody, whoever wrote a book, said, you know what? Rather than having one pattern that takes into considering both zones, we'll just make two different patterns. I guess they made an extra chapter in a book. As I said, as long as the geometry works, you can call it whatever you want. You can call it the Obi-Wan Kenobi pattern, as long as the geometry works where you have commonality from all these different retracements and extensions and projections. That's all you're looking for, really. Chris made the Obi-Wan Kenobi pattern. All right. So the crab pattern, similar to that of that butterfly we looked at earlier, has a much longer type of pattern, where this swing here would be 1618. 1618 down from here to here down, and then from your B to C, and it's rare you see this, it's a 224 to 3618 extension. So the crab pattern has a much elongated type of swing down into your D area, and you do have it. And there is that type of structure. It's just it's not as common as the other patterns that you see out there. So not to get into too deep with this one, but I'll just mark out what your levels are. So let's try this again. From X to A, you got your 382 to 618 retracement. From X down to A up to B, and from A to B down to C, you're looking at 382 to 886 retracement. From B to C up, it's a 224 to 3618 extension, and then from X to A up, it's a 1618 extension up. And that's giving you your D pattern in this whole harmonic or market geometry, your X, A, B, C, D in this particular pattern, this crab pattern. Now there's another pattern called the cipher pattern. All right. Let me just show you I just want to show you what the structure looks like, because you don't have to get so deep into the numbers as long as you have this particular area and this particular area matching up. A lot of times you'll see this. You'll see the X, and this is a newer pattern. It's not that it's newer. People find these patterns from time to time, but there's a couple different ways to look at this, and I'm going to draw this out. One is your X, A, B, C, D, and this right here is 1272 to 1618 extension from your A to B up. Now, the trick is that this C made a new high above A, and then that C to D comes below B, but stays above X. So you have roughly a 786 retracement zone, and you have your extension down, your 1272 to 1618 extension on your D pattern. And that's called the cipher pattern. There's also, you could look at it where you have your X, A, B, C, D, which the D pattern is below your X and below your B, and here is your A. All right, and this is C. So a couple different ways to look at this. This cipher pattern is within the past couple of years, people are starting to pick it up. There's a gentleman, his name was Bryce Gilmore. He's been doing it for 5,000 years. He's kind of retired at this point. Him and Larry Pesavento, these are old-time pioneers with this stuff. They pretty much always had these patterns. The X, A, B, C, D, except that somebody came out and put it on the internet and said, okay, they discovered it. There's really no new discoveries at this point in the markets. So your cipher, or what they call it out there, if you want to do some searches, is an X, A, B, C, D. Whereas you have another market geometry with your X, A, B, C, and then the D point is below the X. So that would come down like this. All right, it would look something like that. All right, it would look something like that. All right. So a couple different ideas, more optional type of patterns to look at. And as we're coming into the 5 o'clock time frame, we're running at about 40 minutes, 45 minutes is what I was expecting to do. You have that, what they call a 3-drive pattern. You'll hear this in the marketplace a lot, 3-drive pattern. And the 3-drive pattern is 1, 2, 3, simple. But what really is the 3-drive pattern? It's your 0, 1, 2, 3, 4, 5, your Elliott 5 wave. That's essentially what it is. And remember, you can have your harmonic pattern, your ABC corrective wave, which essentially becomes those harmonic patterns that we just discussed. All right. Boom. Okay. So looking way back, it all comes down to Elliott wave. It all comes down to price structure. It all comes down to market geometry. And what we're going to do is cut from this week. We're going to cut this video off, and next week we're going to look at doing actual price charts with actual price patterns. So I'm going to go back and look at history of charts and pick out a whole bunch of patterns, all the different ways you could look at it. And then next week, because we learned this week what the harmonics are, what the patterns look like, we're going to match up the pattern theory with the actual patterns and look at all the extensions, the retracements, the projections, and how everything came together. And we'll start looking at it that way. So that way you have a good series multiple videos that you could look at from week to week to catch up on what market harmonics are, market geometry, and basically what they call the Elliott wave, or these XABCD patterns. So there's a million ways to look at it, and a million ways to slice a cat, a million names they could put to it, but it all comes down to XABCD. And with that, we're going to end this week's thoughts on market geometry. And next week, as I said, same time, same place, 4 o'clock next Wednesday, we're going to get deep into the actual price chart patterns with, for Forex, for futures, we're going to get into it. We're going to look at maybe some oils, we'll look at gold, we'll look at commodities, we'll look at all sorts of stuff that have these price patterns, and I'll show you how it all ties together. Actually, I think I may have I'll have something next week. I have an email that came in from a friend of mine who does a lot of work on that, and he sent it to me. So I may have that email. I'm going to check it. It's on another computer, and I'll include some of his work. I'll see if I can show you some of his charts. And he's an older analyst, but all the bigger players, all the big market analysts use market geometry. It's what's been around forever. It's going to be around forever. You know, you can have your moving averages and all that, but static geometry is pretty much where it's at. Market likes to relate and attract to exact price points. It just does. It likes 50%. It likes thirds. It likes halves. It likes relating to prior swings, the exact percentages and prices, and finds, okay, it hits a level and decides whether it's going to stop or go, but they attract. And you'll notice that within any type of a trend, you'll see that, whether it's a dinky trend or a very, very large trend. And if you look back at last night's video that I put, the opening play video, if you look at that video, let me see if I can show you. I want to show you something in terms of price. Okay, I'm going to pause the video for a moment. All right, so resuming the video, let me get my screen up. All right, this happened in the overnight session. Yesterday we were looking at, well, last night actually, when we did the video, we looked at the 0, the 1, 2, 3, 4, 5 Elliott wave. If you looked at our opening play video, then we had our A, B, C corrective wave up, and we were watching for a rally up on this time frame. And we were looking at within this time structure. So if you go back and look at the time that we were looking at of how price and time works, we were also looking at a 36% move off this low, where it only went around 34 points. The point is, next week we'll start looking more at also time, on a much higher time frame. On the little time frames, it's very, very difficult. We'll look at time and we'll look at price and how they all tie together. As an example, you can see 36 points up from this little low. So this would be considered an A to B, C to D relationship. It would also be considered that right here, remember we talked about earlier, that A to B, C to D up, or that ABC corrective wave. And you see how this wave was longer? So let me get rid of some of this jewelry. Okay. We'll just look at a real-time chart. See this right here? Then it came down, and you see that is how you have that, when we discussed earlier, when you have that A to B, C to D, how that sometimes that C to D can be a much greater percentage. All right, so let's take a look. Let's just take a look and see how that worked out in terms of percentages. I know we were looking at the harmonics a few more minutes before. Okay, let's get rid of this. So how we would do this, and this is just an introduction of what we're going to do next week. If I can get my all right. So what you do is you take this swing, okay? And let's do something like this. One for one. Okay. All right, folks, just hold on a second. My computer's somehow, my chart's it's a very, very high time frame. All right, here it is. So let's take a look at this real quick, and then we'll call it a night. Something we could look at going forward, which we will. Okay. So if we took this swing here down, and remember we looked at projections, this swing right here is actually a 141 percentage of this swing up. Okay. Now if we look at the harmonics of it, if we look at this on a harmonic level, let's take a look in what we see. And let me change the price bars so we can look at this a little bit easier. All right. And then next week we'll get into some serious chart work. Okay, if we look at it something like this, it would be a butterfly pattern on that type of time frame where you have that retracement. So lots of little things we're going to look at, and it just takes time to go through this, as you could see. And we're coming into about almost an hour worth of charting today, so not bad. All right, and the other one you would be looking at would be the high down and then a retracement of that swing. You see how that all works? We'll get into this next week. Same time, same bat channel. Gang, have yourself a great night. I'll see those of you in the live trading room. I'll see you in the morning. And